GameStop is now a 10-bagger for me. In other words, my initial investment in the company is now worth 10 times this amount. If let's say I had invested $1,000 in GameStop, now it's worth $10,000. The term 10-bagger itself was first coined by Peter Lynch. This is a term that comes from baseball. I don't watch baseball. I'm not going to talk to you about baseball today. But in investing, this is what it means. You invest in a company today and you make 10 times that amount. Peter Lynch is known as one of the greatest investors alive. He used to manage a fund, Magellan Fund, owned by Fidelity, from 1977 to 1990. And in 13 years, he returned 29% on average per year. In today's video, we are going to talk about Peter Lynch investing strategies, how he used to spot those 10-baggers, and how to invest in them, how to manage the risk of 10-baggers. Because if you're investing in a company that can gain 1000%, it means it can also go down. So how to manage this risk? This is what we are going to talk about in today's video. But first, please make sure to smash the like button for the YouTube algorithm. If you are new to the channel, my name is Ishfaaq. I am a popular investor at eToro, where I manage assets for 550 people. So please subscribe and hit the notification bell so that you don't miss the coming videos. Like we said, Peter Lynch is often referred to as the greatest investor alive. His returns of 29% per year, this is much better than what Warren Buffett did at Berkshire Hathaway, 19% per year. You will ask me why Warren Buffett is so rich, not Peter Lynch. It's because Warren Buffett has been investing for a longer period of time. That's why even if Jim Simons' returns have been over 60% a year, he's not that rich because he started late. And another reason why Warren Buffett is so rich is because he's a businessman. And Berkshire Hathaway, it's not really a hedge fund. It's an insurance business, so they can have money coming in, what they call float, and invest in other businesses. We're not going to talk into details today, but if we look at the exact percentage of returns on investment, then without any doubt, in 13 years, Peter Lynch is the best. Jim Simons, he's a quant investor. We are not going to go there today. During his time at Magellan Fund, he grew the asset under management from $20 million to $14 billion. And then he retired after that. Now he's not investing anymore. But there's a lot that we can learn from him, his strategies, how he used to invest. Success actually comes from only a few companies. It's not just for Peter Lynch, but for many other investors. You look at Warren Buffett. Most of his success only comes from a few companies. American Express, Coca-Cola. Recently we had Apple. That's all. There are other companies he has been investing in, for example, Moody's, but it's not really the source of his success. Even for Peter Lynch, it's the same thing. Most of his success comes from only a few companies. Namely, there have been Fannie Mae, there have been GM, also Volvo, there have been Philip Morris. There are some companies that Peter Lynch invested in, and these companies made great returns. That's what made his success. So how do we detect, how do we spot these great companies? This is the problem, that it is hard to detect these companies. If everybody knew which companies would be a 10-bagger, everybody would be billionaires. It's not going to happen like that. That's why we need to diversify across different companies. Peter Lynch used to invest in hundreds of companies, but only some of them were 10-baggers. Only some of them were these big successors. And the same thing with Warren Buffett or even other investors. You will see they are not focusing on only one company. They are investors who focus on only one or two companies. But these are also investors who do activism. So they are going to try to change the management of the company, to try to have some impact on the company to change it. They are going to grow the profits of the company and consequently the stock price. But if you don't want to be an activist investor, then the best thing for you to do is to diversify across different companies. So how do we diversify then? That doesn't mean that we need to invest in 500 different companies. This is not diversification. Buying the S&P 500 is not diversification. There is the right way to diversify and the wrong way to diversify. The right way is to invest in companies with low correlation with each other, while the wrong way is to invest in random companies just for the sake of diversification. And according to Peter Lynch, you need to invest in what you know. Let's say you know the oil industry very well. Maybe you should invest in oil companies because you have an edge compared to these analysts on Wall Street. They only know about the numbers, but you know about the real business. So you invest in some small oil company, and let's say that oil company has only 2 oil rigs. If they can manage to build a third one, this is a great success for them. It can increase their revenues and even profits by more than 30%. But now let's say someone else invests in a company with 30 oil rigs and now they build another one. The increase in revenues and profits will be only about 3%. We are assuming all the rigs are equal. So you see, if you want to really have a Tenbagger, you need to invest in smaller companies. Companies such as GameStop, when I have been investing in it, the market cap used to be less than $1 billion. If you want to invest in a $200 billion company, it's not going to be a Tenbagger because it is very hard to go from 200 billion to 2 trillion. But it is easier to go from 200 million to 2 billion. So you invest in what you know and in companies that are small. Benjamin Graham, the mentor of Warren Buffett, the father of value investing, he used to invest in hundreds of companies. He used to focus on the numbers. Warren Buffett changed a little. He was still looking at the numbers. The stocks needed to be cheap, but he looked at the business too. But Peter Lynch is more business focused. He's more interested in how the business is being run instead of looking at the numbers. And this is what differentiates him from Warren Buffett. Warren Buffett looks at the present business and then he tries to estimate future crop, but not that much. He looks at present value. This is what matters the most for Warren Buffett, the present value of the business. But Peter Lynch, he looks at future growth of the company. So Warren Buffett will not invest in a company such as Amazon, let's say, because it is a high growth company, but today it is not cheap. But Peter Lynch, he can invest in that company if he thinks that in 10 years, the company will be generating more cash flow than it is doing today. So he looks at future growth. When Peter Lynch is making an investment, he puts more weight on the future compared to the present. But this brings a risk because you cannot predict the future. It is easier to look at the present. You have the real data, the real numbers from the present like Warren Buffett does. It is easier to make that type of investment. You lower the risk. But when you're looking at the future, you don't know what will happen in the future. Maybe in 10 years, Amazon will go bankrupt. There's another company which will be bigger, better than Amazon. Who knows? Nobody knows. We cannot predict the future. So how do we deal with this uncertainty, with this risk? Is by diversification. You invest in several of such companies. Let's say you have 10 companies in your portfolio. You put 10% of your portfolio in each one of them. You have $1,000 to invest. You invest $100 in each one of them. 7 of these companies have average market returns of 10% per year. We are looking at a 10-year period. 2 of these companies go bankrupt. It means you lose your $100 in each one of them. It goes to zero. And then one of these companies is a Tenbagger. After 10 years, that initial $100 investment is worth $1,000. You will see that even though 2 of your companies went bankrupt and 7 of them had average returns, you still beat the market because of that one Tenbagger. So that's how important it is if you can manage to have a Tenbagger. In my portfolio today, I have GameStop. It is about 35% of my portfolio right now. I say that if it reaches 40%, I'm going to trim my position. But you can see the big gains that come from GameStop because my initial investment was only 8% of my portfolio. Now, right now, it's 35%. My portfolio so far this year, 2021, has already returned over 25%. It's mostly because of this one stock. So having a Tenbagger in your portfolio, this can really boost your return. But of course, it is hard to find this Tenbagger. You need to make your research well before investing in any company. It's not because the company is very cheap that it's going to be a Tenbagger. You can look, for example, at Naked Brands. This is a company I've been looking at recently because it gained 600% in a few weeks. So I look at this company, they make underwears and the business is really failing. They have their main business in Australia and New Zealand. It's a failing business. But people are investing in the company. Why are they investing in the company? Because they think it is too cheap. It is a deep value stock. And also Nasdaq said that they are not going to delist the company immediately. They have about 6 months left to be delisted. So investors are hopeful that the company will go out of the bad situation they are at. They can go out of this bad situation only if, in my opinion, there's some activism here. But it's going to be hard for the activists to actually change that business. If it happens, then maybe they can get out of this bad situation, of this hole they are in. But apart from that, I don't see this company getting out of the hole. So just investing in this company because you expect it to be Tenbagger, this is a bad decision. Some people invested in Hertz when the company went bankrupt. It was a Tenbagger for them. It's true. But still, that would have been a bad decision because the company, it only became a Tenbagger because of Robinhood traders, not because of any fundamentals or anything like that. So maybe it can happen, but you're just going to get lucky. So this is one of the characteristics of potential Tenbaggers, that there may be activism. With GameStop, one of the reasons why it is a Tenbagger today is because of activism, because of Michael Burry sending a letter asking the board to buy back shares, and then Ryan Cohen investing in the company. That's why today it is a Tenbagger, because of activism. Another reason why a company may be a Tenbagger, and this works mostly for companies making pharmaceutical companies, for drug companies, if they have a patented drug, and if that drug eventually gets approved by the FDA, and this drug can change the history of mankind, then this can be a Tenbagger. For example, Bionanogenomics, which is a genome analysis company. So they make a scanner which is going to read your DNA to see if you have any mutation, which eventually can be used to see if you can develop a cancer or something like this. I'm not going to go into details today, but this company, they make something that is revolutionary, better than what the competitors make. This device doesn't need approval from the FDA, but they have been selling the product. I mean selling, not literally selling, but selling in marketing. This is what I mean. And investors have been investing in this company. But let's say, I don't know if it will happen, but let's say this product really can sell as much as the company is telling us it will. I believe it will, but at the price that the stock is today, it is too expensive for me. But let's say it happens, then this can be a Tenbagger. It is already a Tenbagger if you look at recent gains. But in my opinion, the company is not worth over $1 billion what it is today. It is too expensive. I know that some of you will be asking me what are the Tenbaggers I see now. Apart from GameStop, are there any other Tenbaggers in my portfolio? There is some. There is a 5-bagger. I think can be a 5-bagger. Freeport McMoran. There's also Trillion, which can be a 10-bagger. It can be also be a 20-bagger. Even GameStop, I believe it can return much more than that. So it can be a 20-bagger. But I'm always looking for more of these Tenbaggers. When I don't see them, of course, I'm going to invest in companies which will give me above average returns. But when I see a Tenbagger, I'm going to invest in it. It's not easy to look for these. If it was easy, like I said, everybody would have been billionaires. So let me know in the comments whether you have any Tenbagger in your portfolio. Thank you for watching this video. Please like, subscribe and share. Please watch these 2 videos here if you have missed them. Have a nice day and goodbye.